You know, when we log onto a trading platform, I feel like we kind of assume it works like a vending machine.
Right,
You
yeah.
see a price, you click a button, and boom, you get your trade at that exact price.
Yeah, if only it were that simple.
Right. But today, we're doing a deep dive into a stack of research on the, well, the hidden infrastructure of trading. Specifically, liquidity providers in the Forex and CFD markets.
Yeah, LPs.
Exactly.
Mhm.
And our mission here is to uncover what these LPs actually do, why they matter to retail traders, and how they kind of quietly dictate the true cost of trading.
Mhm.
So, okay, let's unpack this. Imagine your trading platform is a massive supermarket for currencies,
Okay, I like that.
right? You're walking down the aisles, looking at the price tags, but the supermarket itself doesn't actually make the products. Behind the scenes, there are these huge wholesale suppliers constantly stocking the shelves and, changing those price tags in real time based on supply and demand.
Right, and those wholesale suppliers, that's what the financial world calls liquidity providers, or LPs.
Got it.
We're talking about global banks, hedge funds, major electronic trading firms. And what's fascinating here is that unlike the stock market, where everything flows through a centralized exchange, spot Forex is primarily an over-the-counter market.
Meaning there's no physical center for it.
Exactly. There's no central hub. It's just this massive, invisible network of institutions that are constantly firing off bids and asks.
Okay.
They're basically taking the opposite side of your trade. So they create this environment where you can transact instantly, without having to wait for a specific human buyer or seller to show up on the other side.
Okay, here's where it gets really interesting because wait, so if I see a price on my screen, say I hit buy at 1.0850, I'm not actually guaranteed that exact price.
No, you are absolutely not guaranteed that price.
But that completely defeats the purpose of the flashing numbers on my screen.
Okay.
I mean, I always assumed that price was a guarantee.
Right, it's not guaranteed at all, and that is a crucial realization for any trader.
Yeah.
When you look at your screen, you're usually looking at price aggregates.
Price aggregation.
Yeah. Your broker's engine is essentially scraping a highly fragmented market. So they might pull a USD bid from one LP, right, and an offer from a completely different one.
Oh, I see.
And they combine them to show you an incredibly tight spread. Sometimes it's down to a pipette, which is just a fractional tenth of a standard pip.
Okay, so that ultra-tight headline spread flashing on my screen,
Yeah.
that might just be an illusion of deep liquidity.
In fast markets, absolutely. That top aggregated price tier might only have a tiny sliver of actual volume behind it.
Wow.
So if you place a large order or say the market is reacting to breaking news, that initial volume gets chewed up instantly.
Right.
And then the rest of your order gets pushed down the ladder to the next available price.
And that's slippage.
That is slippage, exactly.
Yeah.
The liquidity simply wasn't there at the exact millisecond your order reached the warehouse.
So if my execution price isn't guaranteed, who is actually dictating that slip? Is it the broker I'm logged into, or is it the LP providing the price? Because I feel like we need to draw a hard line here between the two.
Yeah, we really do. The broker, like Monaxa, for example, using standard software platforms like MT4, MT5, they are just the storefront.
Right.
They give you the charts, they give you the interface, but they are pulling their inventory from those institutional LPs, the warehouse.
Okay, so the LPs of the warehouse.
Yes. And if we connect this to the bigger picture, this dynamic is exactly why leveraged trading gets so incredibly dangerous during low liquidity periods.
Because of the amplification?
Exactly. Leverage amplifies your exposure, but liquidity does not scale up to reduce your market risk.
Which means if a massive news event drops, like, I don't know, an unexpected interest rate hike, the LPs might just pull back.
Yep.
The warehouse stops shipping goods.
Right, but we have to understand why they stop shipping. Unlike a real warehouse, an LP's inventory is pure financial risk.
Oh, sure.
So if a massive news story breaks, they suddenly don't know what the currency is actually worth yet either.
Or they're just protecting themselves.
Exactly. To protect themselves from selling to you at a massive loss while the market reprices, they just widen their spreads.
Or just pull their quotes entirely.
Yeah, exactly. They pull their quotes entirely until the dust settles and price discovery resumes.
Oh, man. And if you're stuck in an open trade when that happens, you are just left hanging.
You're in trouble because if the market gaps and liquidity vanishes, your protective stop-loss order doesn't guarantee an exact exit price either.
It just triggers a market order.
Right. It simply becomes a market order. And if the LPs have pulled their quotes, that market order triggers at the next available price.
Which could be materially worse than what you planned for.
Way worse, yeah.
So what does this all mean for the person sitting at their computer?
Uh,
I mean, the practical takeaway from all our sources today is that you really have to look way beyond that headline spread a broker advertises. You
Absolutely.
need to monitor your actual execution, track how often slippage actually occurs in your account, and honestly, test your strategies with small position sizes in fast markets before going all in.
Yeah, you have to test it. And that leaves us with a pretty compelling question to consider, I think.
Yeah.
Think back to that supermarket analogy. You can pick the right aisle, you can choose the exact right product, and be completely accurate about the market direction.
Right.
But if a trade can still lose money simply because the wholesale suppliers decided to pull their liquidity to protect themselves, you have to ask yourself how much of a trader's success is actually based on their own brilliant strategy versus just surviving the unseen execution mechanics of those institutional giants.
Man, that is a really fascinating way to look at it.